Hello and welcome to session 2 of the pullback course. Today we're going to be, and this might be a little bit of a departure from one of the earlier outlines you saw in the material. We're going to talk about trends and then look at actually some of the variations pullback patterns take. The second part of that was not something that was in the original outline, but I'll tell you this, all we have done is we maybe kind of move some things around to different days. So everything that was on that outline we will cover, and there's going to be some new stuff added. So that's a little bit of what we're looking at today. Also, one of the things that I'm going to do as we go through the course here, I'm not going to do a lot of explicit review from the previous day because, as I said, we're going to be circling around some of these concepts and seeing things over and over. But I would just encourage you, particularly if this way of looking at patterns and thinking about markets is new, I think it's worth your time is new to you. I think it's worth your time to go back and make sure you watch each session. It's be a good review to watch the previous session before each one. And if you're watching them on a replay, of course, you have lots of ways to do it. So here's what we're going to do today. We are going to look at trends. We're going to talk especially about how trends begin and how trends end. The middle part of trend, the easy part of trend, is easy. And if you were able to identify with any degree of reliability, if you had some like magic crystal ball and you, as opposed to not magic crystal ball, and you knew that a market would continue to trend, it would be extremely easy to trade. So what we really need to focus on as traders from a practical perspective is look, what do we see that shows us that a trend might be beginning to break down? For instance, we're also going to look at specifically how, as a trend is moving and making these pullbacks, what do those pullback patterns look like? And we're going to look at some current examples from the market as of yesterday's close. So before we start, let's talk about trends. So there is actually a little bit of a debate. There are some people who I think are crazy people who will tell you that markets don't trend. And how could you even have a debate between people who say markets don't trend and markets trend? It seems like such a basic thing. And the reason is the answer is right here, that it depends on how we define trend. And it is certainly possible to massage the numbers and to use tools to look at market data to come out of that and say, hey, there's not even such a thing as trend. So one thing that used to confuse me a lot when I was learning to trade and reading books, people would talk about, let's just take trend here, but many aspects of markets. And I would say, well, like, what exactly are you talking about? How do I measure this thing? A very practical question here, and we'll look at charts a lot today, but how do you know if a market is trending or not? How exactly do you define that? And the reality is that whether you know it or not, you're using some kind of tool to answer the question of is a market trending or not. Common tools are right here, trend lines. One of the most effective, I think, is to use a pattern of, so you're looking where a market's making, holding higher lows and higher highs, but even that is subject to some confusion, and this is a useful framework, but you have to understand how to apply it. A lot of people use moving average crosses, but there again, the way this would work is you have a shorter term moving average, which is going to stick to price much more closely, and a longer term moving average. What numbers are you using? Like if you use a 3 and 10 period moving average, you're going to get a different number than if you use a 3 and even 11, but certainly a 3 and 50, or if you use a 10 and 50. So 10 would be your fast there. You're going to see that in any chart, you're going to be able to make any specific bar by some definition say something else. And so all of this is, I would not say, this word here was pretty carefully chosen. It's not that it's subjective. It's not that it's just your opinion, but it certainly is, subject to some interpretation. The other things people use, one of the tools that I have found myself using more and more over the years, is a slope of regression lines. And that sounds complicated, but it's not, and it's especially not hard to do with software. Basically, you have closes or you can use, and for those of you who are more quantitatively inclined, just to kind of talk about this a minute, with a bar, you have 3 significant data points at least: the high, the low, and the close. You could throw the open in there, but practically speaking, we don't. And a lot of technical tools are calculated off of the average of that high and low and close. The problem with just taking closes is and you will see this in a moment when we talk about volatility, you're blind to the range of the bars. And a lot of academic measures of volatility, they don't know if bars are giant or small because they're just looking from close to close. So all you do is, whether you're using the closes or that average of the high and the low, add the close in there, double weight the close, whatever you want to do, and then you just look at the slope of that line. Yeah, but still you have to have a cutoff. If you're just just looking at my hands here, it's just very imprecise. If you have a line that could slope, and it's going to slope in different ways, but at what point is it trending here? Is it trending here? You still have to have some number that says this is the cutoff where it's actually trending. And also realize that anytime we say a market is trending, that's backward looking, and it doesn't tell us necessarily what's going to happen in the beginning. And just to make this real, look at this chart of the 10-year Treasury notes now. Is this market trending? Well, yeah, obviously, right? So and one of the useful, by the way, I'm not criticizing this at all, one of the useful definitions of trend is you can see the chart starts in the upper left-hand corner and goes to the lower right-hand corner. So prices in this chart have clearly followed this path. Now, why is that not a perfect answer? For one thing, it depends on, if I expand, and anybody using software, we know this now. We have to be careful because a lot of the very intelligent things that were written earlier in those old technical analysis books, they were not able to rescale charts as easily as we were. So they might have thought there was more significance there, but depending how much data I put on this chart, I can make it look very different. And in this particular case, yeah, we are in a downtrend, but where does the downtrend start? Does it start here? Does it start here? Are we downtrending here? Market went up for a little bit, right? Are we downtrending here? Are we downtrending here, or are we flat? So these are the kinds of questions that two people could look at a chart and could have very different opinions of what's going on. Are we downtrending here because we've been going up for like a month? So is that something that happens in downtrends? Does the market go up in downtrends? That's the challenge of these definitions. But if we're looking here and we want to understand in very broad strokes, how does the market get from a higher price to a lower price, or vice versa, a lower price to a higher price? And it's pretty clear for anybody who spends 3 minutes looking at charts. If you've never seen a chart, it's pretty clear that these lines I've drawn over here to the right of the screen, that's not the way it works, right? You don't just see a market go in a straight line from one price to another. That's not reality. Reality is something like this. This is a useful way to think about the market. And one of the things also that I'm not going to do in this course is I'm not going to coddle you. I'm not going to give you like the 101 example of many things. You have a 101 example here. But the way when you write a book, what you do is you show people very idealized examples of the patterns, and the patterns the market makes, and we might even use a lot of line diagrams like this just to show very simply. So like if I want to talk about a trend, maybe maybe I would show you a diagram like that. And then maybe I'd show you how it can switch into an uptrend. And so you have this very idealized structure that in the sense of like the Platonic ideal of a trend. But then when you go look at a chart, I just flip to the next chart. Right? Like how does this actually work? So what I'm doing here in this course deliberately is I'm taking you straight to that where you're seeing the real market patterns, and then we'll start to tease out the truth, with the exception here. So this is what this shows is markets, generally speaking, will make a move in one direction, and then we'll have a move against that and a move in the same direction. We talked about why that might be in the previous session quite extensively. We talked about their psychology here. One of the other things that you need to understand is that this pattern is fractal-like. People like to say that markets are fractal. So what we mean when we say something is fractal is that if you, a very imprecise definition here, and if you want to know more about it, Mandelbrot writes about this in that book, The Misbehavior of Markets, is a book I would strongly recommend. And he was one of the pioneers of applying chaos theory to financial markets. You might remember, it's been a long time, but I think he made a splash back in the 90s, maybe, with this idea that prices could be affected by butterflies' wings somewhere, setting up this chain of reactions, and it's possible to think about that. But he talks a lot about fractals, and if you zoom in on different time frames, you see the same pattern. So the idea is, like, this leg up here actually has this impulse wave in between it. And in fact, if you were to zoom down here, this leg up also has the and you see that, right? So like each of these has this type of structure within it, and this down leg here also has an impulse leg within it. And people say markets are fractal. I think the more precise way to say it is that they're fractal-like. They're a lot like fractals because you have issues of liquidity and tick size as you get down to lower time frames that change things. But this is the basic underlying structure that is here. But now let's look on the chart. Do we see this structure? I'm just going to highlight it in a few places. But if I tell you it's the basic underlying structure, what you should expect is, okay, Adam, so it should be there all the time. And like, here's a very clear example of where it does seem to be. Here's a less clear example of, see, this leg up, this leg down, and this leg up seems to be there. This seems to be here, down, up, down. Now, what about this? So you see, if I make a mark, it's not easy to erase that specific mark, but you see the space in between those two lines. It's not quite so clear here, right? If you zoom down on a lower time frame, you would undoubtedly see that there is some stuff happening in here, but it's not so clear on the chart. See, but this probably resolves into some kind of more complicated leg like this. So the point is that these idealized structures, and this is why we're not going to do, I'm not going to give you hours of video here filled with diagrams like this, because when we actually get down into the dirty real market, we need to see how these things apply. And this, I will tell you, even though it looks like the structure isn't here very clearly, it actually is. And this would shape this is, by the way, a 5-minute chart of the S&P. And one thing that I'm doing here, I really want to focus on giving you things that are kind of happening right now. And I am deliberately not going back and looking for the best examples of charts or some of these things. I want you to see, like, if you were dealing with this on the 25th of May, 2022, so this is the overnight session. What kind of structure would you have seen? And let's also just give you a little preview of what we're going to look at later in the course, or later today. This is we're going to see this again. Look at this little structure here. And look at this little structure here. Now, these are pullbacks, right? This is one of and this is something that if you have read my books, this is a pattern that I certainly was aware of, but I had not used in a formal sense. And as I continued to do daily market analysis and then talk to people about that analysis and to teach, I started to see this pattern more and more. And I think this is one of the more important things you need to think about. This is what I call a nested pullback, and I'm not super impressed with my terminology there. But a nested pullback is, I'm going to draw schematically here. So you have a market that's downtrending and it goes up into a pullback leg. And the classic outcome is that, right? That's what we look for. But in a nested pullback, you go up and you have the pullback, and then the pullback starts to work, and then you have some kind of little pause. And this little pause, which may be a pullback, it may be just one or two small bars, but this pause is a very useful way to get on board moves. So what you're looking at here in this one, you had this pullback, which this is quite an extreme pullback, but on intraday overnight data, this is into the open of the European session. This is it's something you need to understand if you trade intraday charts, is that time matters a little bit. That makes this little move here, which doesn't seem particularly compelling, sitting right here on support. That's a very powerful pattern. Look here, this is another, relatively simple pullback. It's actually technically what we call a complex pullback, but this is just a pullback that melted lower. Look here, here's a bigger pullback, and then look here. Look at this little pause. See that? That's the nested pullback, and that's the little side road we took here. I'm going to show you more examples of a nested pullback, and this also is a nested pullback. Now, why do you need to know about nested pullbacks? Short answer is they happen, and if you know about them, you can use it. It's a useful tool for entering and exiting trades, or rather for not exiting trades, because if you don't know what's going on here, and let's say your magic crystal ball was working and you got short on this bar. Very good job, good work. And then let's say you're sitting here and the market makes this little pullback, and you want to, in this case, we haven't talked about exit strategies, but let's say you're going to play for the biggest move you can, and market makes this little pullback. You're like, oh, it's going up against me. Do I hold it? If you understand nested pullbacks, and you understand that the pullback here is very likely to generate some pauses, you're not going to be concerned. Or, if you took partial profits, you could even use that inflection to put trades back on. So it's very important to understand this nested pullback, and I'm going to explain it again here in a few minutes, as one of the really fundamental structures of how markets move. Another thing to talk about here, and I don't want to get too distracted by this, but the measured move objective. I'm going to go back a couple slides to that simple schematic. So the measured move objective, what it does is it takes this leg. So let's call this the setup leg. Let's call this the pullback leg, and then let's call this if call it the setup, let's call it the result leg, okay? So what the measured move objective does is it measures the size, and we can look at time. Let's just look at size first. It measures, and that's not precisely done, but it measures the size of this particular leg, of the setup leg. And then it says, okay, so this setup leg moved this much, and then it takes that same expectation and moves it over from the bottom of the pullback leg and says that the size of the resulting move, so here's your setup leg, here's your pullback leg, the size of the resulting move should look like this leg. And whether the pullback itself is very deep, you're still going to get the same thing. If the pullback itself, I'll just draw over everything here, is very small, you're still looking that this leg looks like this leg. This leg looks like this leg. That's the concept behind the measured move objective. Now, does it work? Well, yes, it works. It works sometimes very well. Here is a pretty good example of where it works quite accurately. But look here is, and it's a question of, do you take this as the setup leg or this is the setup leg? But if you were to look here, we had a fairly significant extension. So what I'm saying here is, let's call this leg 1. Let's call this leg 3. Leg 3 is quite a bit bigger than leg 1. So what's going on here is that the measured move objective is a useful way to look at markets because it gives us a reasonable expectation. I'm saying for the second up leg here, and that's in this kind of structure, but is what I just labeled leg 3. So you have leg 1, and then the pullback itself would be leg 2. But just to be clear, that's what I mean here. It's a reasonable expectation. It is not a hard and fast rule. It is not a line in the sand. Those things don't exist. That's one reason why I'm so critical of the way so many people think about Fibonacci, because they think, oh, like it's an absolute thing. No, it's a reasonable expectation. And here's why it works. This is also why Fibonacci works and why people get confused. So this is the expectation is based on the assumption that future volatility will equal current volatility. Now, it so happens, how good does that assumption seem to you? Seems kind of naive, right? Because what we're saying is the future is going to be like the past, and that seems lazy. It seems like you're right. However, that's actually a very, very good assumption, because there are thousands of academic papers published on forecasting volatility. When we forecast volatility, what we do is, we look at what's happening right now and we say, here's what's going to happen in the future. That's, with any kind of forecast. And it turns out in those thousands of academic models, you can easily search Google, find many of those papers if you want to read them. A lot of those models are very, very similar. And one of the strongest factors in all of those models is current volatility. So even for super sophisticated quantitative work, the best place to start, what's future volatility going to look like? The answer is current volatility. So this is not a naive assumption at all. This is actually legit, and I'm belaboring this point because it's important. This is a powerful and valid way to look at markets. And as I said, just treat it as a guideline. This is the key here, and this probably should be in orange text or something. The measured move objective will be violated, will be wrong if volatility changes. And that's what happened here. That's why this leg is longer, was because volatility increased. And here's another case where it worked reasonably well. So just understand that if you're looking at a market and you have a reason to think that, let's say the market's swinging really crazy right now. Let's say it's a stock that just got an upgrade or downgrade, or just reported earnings or something, or a crop report just came out in grains or something like that, and the markets, or our central bank made a decision, a currency or interest rates are moving. And do you really think that volatility is going to continue in the future? Or you think it's probably going to die down? There you have some reasonable, expectation. Conversely, if one of those events is going to happen in the future, very classic example when this happens is when we know the FOMC report is going to come out, and we know markets are likely going to make a big volatile move in response to that information. So if volatility is going to change, that's when you know that your measured move objective is likely to be badly off. But if you're just looking at normal markets, that assumption that the future will look like current data is actually a reasonable assumption. It's also important to understand volatility in at least two ways, and this is something that we could actually speak about for hours. But volatility, as it is classically measured, you're looking at how much something bounces around. It's a measurement of uncertainty. And that is certainly valid, and it's the way options price volatility. It's correct. There's another kind of volatility, though, that really matters for traders, and I think about this as more directional volatility. So if you have a market, and this frankly is not something that academia is very well in tune with, but you could have a market that, so volatility, that's higher volatility. There's one is more unpredictable than another, but you also can have this result in a market making a clean move, our market making a less clean move. And this is a different kind of volatility that is hard to measure, but it's also correct when you're thinking about future outcomes of your trades. And in fact, I think this is the point where we begin, is trying to understand how is the market likely to move in the future. One of the ways you build up that knowledge and that expectation is by looking at a lot of data, by seeing a lot of charts, basically. Let's talk about momentum. So I believe the statue here is a statue of Janus. And if somebody is more in tune with classical sculpture and I'm wrong, tell me I'm wrong. But here's what I do know. Janus was a Roman god that had two faces. And he was the god of beginnings and endings, of war and peace, things like this, of planting and harvest. And this is a very apt comparison to momentum, because momentum is the way to think about momentum. It's a little bit hard to define with precision. We'll come back to this. We'll come back to the definition in a moment. Let's talk about it like we know what it is. So momentum is something that comes at the beginning of a trend. If you have a quiet market and then all of a sudden, boom, there's a move, that's new momentum. That's an explosion of buying or selling pressure, depending which way it goes. And if you see very convincing momentum come out of a quiet market, that shows us that this move is likely to continue. However, the other face of momentum is if you have a market that's trending along, we talked about this a little bit in the previous session, right? And then all of a sudden like explodes up higher, that explosion of momentum in a ongoing trend. Because you got to be careful, right? I almost said in a mature trend. Well, what's a mature trend? Because let's say you have a market that's trending for, oh, I don't know, I mean, look at the stocks, which have basically been trending since 2009 upward. There have been some sideways years, but we've been in a very, very long-term bull market. And anybody who wants to argue against that is playing very silly games with definitions. We've been in bull market since 2009. That's obvious to, I like to use the phrase any idiot, but whatever. That's probably unkind. But if you have a market that's trending that long, at what point was it mature? Because a lot of people would have thought that bull market was mature 3 years into it. And here we are many years later. A lot of people certainly would have thought it was mature 5, 6, 10 years into it. So you do have to be careful that when you use, there's so many assumptions baked into our language. But if you have a trend that is underway and then you have momentum explode in the direction of a trend, that's one of the classic ways trends end. So one of the mistakes that people make, and this goes back to what we were talking about in the previous session, trading around climaxes, where you see this new momentum and you think, oh, everybody else wants to buy, I'm going to jump in and buy. What you've done here is you've fallen into one of the typical traps. And momentum, as I said, there are a lot of definitions of momentum, and the one that I'm using here is basically how fast the prices move. If you're looking at a chart, it's how vertical, up or down is the move as opposed to sideways. All these other definitions that I've grayed out here are also appropriate. How do we measure momentum? Some indicators are very helpful here. And one is the MACD fast line. And for those of you who have not seen my work, the tool that I find particularly useful is a MACD that uses these settings, 3 and 10 for the fast line. These are not the typical settings, but this is a setting that was used by a charting service back in the 1980s, I think maybe even back in the 1970s. So what you have is you have this large body of old school traders that use this tool, that understood this tool, and so it's kind of deeply ingrained in a lot of people's brains. But many modern charting packages, you have to massage it a little bit. So you use 3 and 10 for the fast line. You use 16 for the slow line, and that people use signal line, sometimes the term that's used. And the thing that is perhaps most difficult to set with modern software is you want to make sure that you're using simple moving averages here and not exponential moving averages. If you use exponential, you'll get quite different lines, and the tool's still useful. You can also use stochastics, you can use CCI, you can use a lot of different indicators can be used to help measure momentum. But just so you know, the one that's on my chart and the one that I use is this 3-10-16 MACD, made with simple, not exponential moving averages. And we also have no MACD histogram on the charts. You put on there if you want. Sigma spikes, I've written about this extensively. We're not going to really talk about this much in the course. It is on the charts. If you want to know about Sigma spikes, you can easily search, go to Google, type Adam Grimes, Sigma spikes. Sigma spikes actually will probably get it done, put it in quotes, and you can see precisely how to calculate it. It's no secret. It's just basically a measure of big moves. One of the really, really, really effective ways is to look at a market making a move to the Keltner channels, particularly the first touch. And I'll show you what this means. You can also just use your eye and look at a chart and say, oh, there's good momentum, but you do need to be careful because that is a wildly subjective definition. And as you get more data on the chart, it might look different. But if you are just looking at a chart, which again, I'm not criticizing, it's not necessarily a wrong way to do it, but consider whether you're going to look only at one single bar, or will you look at a set of bars that can show you momentum over a little bit of a longer swing. I also want to talk a little bit here, and I have 4 charts, which I'm going to page through with a little bit of commentary, but I would like you to spend some time pausing the video